Hello everyone, and welcome to today's webinar. I'm Haydon. I'm one of the partners at Castlefield. I'm also a chartered financial planner. And I'll be joined by my colleague Olivia, who's also a partner and chartered financial planner. Today we are going to run through 10 steps to planning your retirement. Olivia, are you there? How are you?
Thank you, Haydon. Yes, I'm very well. I'm here. And yeah, I loved reading through your 10 steps, 10-step plan. I think it's a really useful document, and the earlier people start thinking about their retirement, the better, really.
Yeah, we have a lot of clients that are in this position. They're either newly retired or coming up to retirement, and of course it's an important thing to plan for. So hopefully this will prove to be a useful guide. So should we get cracking?
Yes, I've got my retirement plan, Haydon. I don't know about you, but I would like to live near the sea. But of course, I'm worried about the rising sea levels with climate change. So that may affect us. And I also want a big garden.
Oh, well, there we are. I like it. Aspirational. That'll come back. That'll come into point one. So point one, this is good. This is, can I visualize my retirement? So this is more to do with thinking about what your ideal retirement would look like rather than the numbers. I mean, when you talk to your clients, this is a good starting point. I imagine this is something that you bring up fairly early on, isn't it?
Yeah, I'd say most clients actually are planning for their retirement, aren't they? That's the most of us need to save for that, for when there's no longer an income coming in. And it can be a lovely time of life where you have fewer demands on your time. You may be grandparents. You can really look at life afresh, and we help clients do that. And it's not always easy, is it, imagining what ifs, but we help guide people. What about you? What are your plans?
Well, yeah, absolutely. I'm similar to you in terms of, yep, nice garden, nice relaxing time. Might have some grandchildren by then, we'll see. But yeah, it's definitely something to plan for. The type of things you need to think about. What are you going to do with your time? Are you going to do things such as help a charity and support a cause? Will you get involved with your children? Maybe you'll be doing grandparent duties, that type of stuff. So as a good starting point, I think it's just really good to sit back and think about these things and map out in your mind what an ideal retirement looks like, and then as we'll go through these steps, you can build on that. Okay, so we've visualized our retirement. I guess we move on to step two now, firm up a bit on that. It's actually deciding when you retire. It can be an obvious date, Olivia, can't it? But it's not always necessarily so straightforward as that. I mean, what's your experience?
Yeah, I found a lot of clients prefer to ease into it, and that just stopping on a certain day from going sort of full-time working to nothing can be a bit mentally challenging. So I think lots of people like to ease into it, but there might come a point where you're quite happily working along, but then you're about to become a grandparent and you suddenly think, oh, my priorities have just completely changed. Now's the time to stop. So it's very personal, isn't it?
Yeah, absolutely. I mean, one of the things that I've found in the past is that it can be quite a progressive thing to actually take a step change to retirement. So you don't just fully retire overnight, and maybe you move down from 5 days a week to, say, 2 or 3 days a week. And often I've spoken to clients and suggested that they talk to their employers who are often amenable to that, especially in public services. I mean, it's a fairly standard thing that you can opt to work 3 days a week for a couple of years, and it just helps you orientate yourself towards getting used to the idea of retiring fully. So it's definitely something you need to think about. And then when you do that and you talk to your financial planner, your financial advisor, they can help you with the numbers really to work out your income's going to go down by X, but then maybe fill that in drawing on some of your investments or something. So yeah, number two, try and come up some dates as when you retire, and maybe step into it. Okay, shall we move on? Number three, as part of your retirement plan, then you need to work out what you have in terms of financial things to support you, and how might that change? over time. I mean, again, Olivia, this is something that's common, isn't it, with the process that we go through with clients?
Yes, and you've helpfully put in the fact sheet that people should obtain a state pension, which is a forecast, which is a really good idea. So you know whether you're missing any years, because you can pay a lump sum to catch up on missed national insurance years, which go towards the state pension. But it's good to know sooner rather than later, because it can cost a few £1,000s to do that. And that's on the gov.uk website. You can apply for that with you need your national insurance number and other bits and pieces. And you also mentioned getting pension statements, which your pension provider should send to you every year. And I just wanted to make the point that if you've got a personal pension, then they will, the annual statement will predict what the pension could be worth in the future, and also what income you might be able to buy at your normal retirement age. But often that income is really low because the pension company is basing the projected income on annuity rates, which are very low, at historically low levels. And so I think some people get put off by that and think, why am I bothering to save? It's going to give me £75 a year or something. What's the point in that? But actually, it's more helpful sometimes to look at the final predicted figure of what the overall pension is going to be worth, which will be a larger sum. And then you do have more flexibility nowadays in how you spend that pension pot.
Yeah, you're absolutely right. To start with those type of statements is a really good starting point, and try and just carefully work through them. But I mean, you will be the same as me. You get clients that turn up and I realize that the people that produce these things are just trying to be helpful, but sometimes you can't see the wood for the trees, and there's all sorts of information in there. So you and I are used to just picking out the relevant bits of information. But yeah, there should be deep buried down there somewhere some semblance of an idea of what you might get. I guess as well as pension figures as well, of course, people rely on other sources, rental income, investments, savings, whatever it might be. So you need to accumulate details of what you've got, maybe set that up on a spreadsheet if you're used to using things like Excel, or even just create a quick ledger of your own to note down everything that you've got and put it all together. I guess the final thing to note on this is, don't forget, I mean, this is jumping onto a point later on, so I'll cross it off there in more detail, but you'll be paying tax when you're a pensioner, as you will when you're pre-retirement. So be careful that you don't just make a note of gross values. There should be net values when taxes come off. So you might not be able to calculate it yourself, but that's something an advisor would do for you. Should we move on to number 4? Have you got more to add?
No, that's grand. I was going to say most people are probably going to be basic rate taxpayers in retirement. So that means, broadly speaking, taking 20% off for tax. So you could do that as a very rudimentary sum if you didn't know all about the tax allowances that would be available to you, etc.
Yeah, of course. And I guess the final thing to say on that, of course, once you reach your state retirement age, you no longer have to pay national insurance as you do when you're younger. So you end up with a little bit more in your pocket
a year.
Yeah. Worth being aware of that. Okay, let's move on. Number 4. So we've just talked about the money coming in. As we do, there's the money going out. What do you need? What do you need to retire on? What are you going to spend? How will you spend it? It might be the same or similar to the amount that you spend pre-retirement. It might be completely different. I mean, this is, again, Olivia, we both talk about this stuff a lot, don't we, with clients?
Yes, and of course, you're going to have more time when you're retired. So you could actually potentially spend more money, or you might envisage just spending a lot of time at home in your beautiful garden or whatever. And actually, when you're working, you have high travel costs and they're taken away, then you might spend less. And I do have some clients who get a bit sort of fixed on trying to do almost too good a job and not really getting anywhere because they want to be very precise. And you can't predict the future. Everything that we do in life involves some guesswork. So I encourage people to just take a bit of a stab, just trust their instincts, and if they're a few £100 out, doesn't matter. It's just to get something on paper that feels about right. And you say again in the fact sheets that it's a good idea to have your fixed essential spending, stuff you're really not going to be able to, there's no negotiation, you're going to have to feed yourself and pay the bills. And then there might be discretionary spending, which might include haircuts and leisure activities. And then there's a sort of one-off big stuff that you might want to pay for as well.
Yeah, again, it's useful just to document this stuff down, and this is where a spreadsheet works brilliantly. And I guess the stuff that you just started with there, the essential spend, that's the easiest thing. You can get details of your council tax bill or whatever off of a statement or off of your bank statement. Discretionary spend, I mean, I often have clients say, well, it goes up and down, I'm not really sure. But there are ways you can do that. You can either just have a sort of sensible estimate, or what the occasional client does is they look back 12 months worth of bank statements, adds up a certain spend. Let's take haircuts and just give me that example, and then average that out as a monthly amount. So it's good to try and keep, if you're going to look at this on a consistent basis, keep it in monthly terms. Don't try and mix and match it up, or you might want an annual total. And then the third set of spending is something that isn't necessarily going to be repeated, but can be quite expensive. So it might be if your children are going to get married one day, you want to ring fence some money to give them towards that, or give them house deposits. So you almost keep that in a sort of separate column, but it's still important that you do budget for that, and that's all part of the planning process. You take account of that. Okay, let's move down the list. Number 5. It's all looking rather good so far, but tell me, Olivia, tell me what can go wrong with this sort of stuff? I think you've touched upon it already, but what are the risks when you're putting these facts and figures together?
I suppose it's important to build in a revision, isn't it? Because life can throw all sorts of curveballs at you, and it's great to have a plan. And if you fail to plan, you plan to fail, as the catchphrase goes. So have a plan, excellent, but it needs to be flexible, and you mustn't get too disheartened if something happens that wasn't on the spreadsheet, but so that means that really you should be looking at this every year or so, and just making sure that you've taken into account any changes to your income, any changes to your expenditure, and that sort of thing. And also you might be busy putting money away, but where's the money actually invested? So is it in a fund that's really low risk, that's just not going to grow very much over your time horizon? That's a potential. It might not be invested ethically, and your personal values might be very important to you. So these are things that once you've got the savings plan set up, or when you're thinking about setting them up, there's another layer that you should be thinking about as regards that as well.
I mean, that's all excellent advice. I guess the two other things I would suggest that when you're putting this together are try and be as accurate as you can, but if you're going to go one way or the other, perhaps underestimate the amount that's going to come in if there's some debate over it. Let's say, for example, you're an author. We've got quite a lot of authors on our books that write books, and they will try and project forward what they're going to earn from the next publication. But that's a difficult thing to do. So we will always encourage them to think, well, you're actually going to earn less than you might. And if they get extra, it's a bonus. If you do it the other way, you can be in trouble. And then the other thing to do is with the outgoings, try and overestimate them. I'm going to spend more on X than I probably will if you're not certain. And if you build that in, that's some natural type of protection that you're giving yourself. But also add in a contingency, I'm going to need this, I'm going to earn that should cover it. We'll add on 10%, let's just be certain here. And then I guess the last thing to really pick up on this is if you see a financial advisor, again, Olivia and I do this day in, day out, but any good advisor will. And we have software available where you can plumb this stuff in and you get some very pretty shiny graphs. We call it cash flow planning, and it'll show you where the gaps are coming up in the future, and then we can work out how to fill those in. Now, if you're doing this yourself, you're not necessarily going to be able to do that, but just be aware that can be done. Okay, do you think we've covered that off? I guess, there is one other point on this, is things change. And if you can see the changes coming, do try and plan for those. So the obvious one would be you're still paying off your mortgage, but that's going to end at a certain point. Mm-hmm. Or it might be that you're supporting, I have a lot of clients that support grandchildren through education. and they might pay university fees for their grandchildren, but that'll end at one point when the grandchildren graduate. So don't just project for today or the near term. Try and think long term as well, make a note of those as well. Right, we'll move on to number 6. Okay, we're getting in a bit more detail here. These are some nuances here. These, again, we touched upon these things a little bit, but let's explore them a bit more. What are some of the other things that we need to think about that can impact on the numbers?
So we've got tax, of course, and we produce annual tax tables, which are on our website, which are really handy one-stop shop for the key tax allowances that people can benefit from. Some people will have an accountant who can help them, although not all accountants are actual tax advisors. They might be happy to do your books for you. It doesn't mean they're going to tell you how to save tax. But we've caused, the basic things are to use your ISA allowances so that any money that's inside an ISA will not have to pay capital gains tax or income tax. That's really valuable if you build that up over time. And when you're making pension contributions, you can get income tax relief on those pension contributions. You have to be careful you don't put too much into pension in any one year, because then you could be trying to claim too much tax, as regards what's actually allowable. There are allowances like the married couples allowance. So if one of you is a non-taxpayer and the other is a basic rate taxpayer, you can actually share the non-taxpayer's personal allowance, which means a higher level of tax-free income for the family or the household. So there are various things you can do, and some people love this sort of stuff. I have to say most of my clients probably don't, but maybe that's why they have a financial advisor.
Well, no, I think that's some really good stuff there. It's funny, actually. I was in a client meeting this morning with a couple who've just become clients, and I was and one of them earns a decent wage and one of them's non-taxpayer, and I raised the marriage allowance. They're very pleased about that, and I talked them through how to claim that, and that's such an easy way to get a little bit of tax back from all that tax you've paid over the years. So yeah, those are some great examples of tax allowances that you should take advantage of. And then I guess just to reiterate what I touched upon earlier, try and understand the tax that's going to come off when you start taking stuff. So if you've got investments that are going to make good returns each year, there's capital gains tax that you might end up paying if you exceed the annual capital gains tax allowance. There's lots of ways you can mitigate that stuff. But yeah, I mean, it's difficult if you're not a professional doing this, but be aware that it will all have an impact.
And you've also got a bit more choice. If you run your own business, then you don't have to make employee pension contributions. For example, your business can make employer pension contributions, and then it becomes a case of weighing up which is the best route in terms of the overall tax saving. Will it be better that the company gets the corporation tax relief, or is it better that you as an individual get the income tax relief? So that's another thing to consider if you've got you're responsible for your own business.
No, definitely, yeah. That's a really good example. There's heaps of ways of doing these things out there. Okay, I mean, if we just move on in this category, a subcategory, is to think about not just tax, but the other costs that are involved. You've got to be careful. I mean, you can invest in certain things that seem very clever, but can be very expensive. I mean, you must talk about costs with clients, I should imagine, most meetings, well, a lot of meetings.
Yes, and I mean, the costs of getting professional advice and then investment management, they do all add up. But as long as you think you're getting something good and positive for that money, it will cost you. But, I suppose it's if you're paying for things and you can't really see why or what an organisation is doing in return for you paying them the fees. And the good news is the cost of funds has come down quite dramatically in the last 10-15 years, and also initial fees are less common when you're investing money directly. So we will typically charge a financial advice fee, but actually when you're putting the money into the market, there's very rarely an initial fee now, whereas it used to be up to about 5%, didn't it, Haydon?
Yeah, absolutely. I mean, you've touched upon something that's important, cost of funds. So that's when you build an investment portfolio and there's a far-flung fund manager somewhere behind the scenes managing that money for you, taking money out of the pot that you might not be wholly aware of. I mean, you need to be told this on a basis nowadays. but that can have a dent on your returns. But yeah, I mean, there are other costs as well. So you might be advised to get out of investment A and move into investment B, but there could be a really big penalty behind doing that, which doesn't justify it. And so, although it might not be the perfect investment for you, ultimately staying put where you are is important. Now, that might not necessarily earn your financial advisor some money if you leave that thing behind, but you know, if they're the honest type, they'll just tell you straight. So things work out that are best for you. Okay, the third thing that we've got in this category, and this is a key thing, this is something I use quite regularly, is the timing of what you do, especially in terms of using tax year ends quite cleverly. I mean, just tell me a bit more about that. What do you do when you're helping clients with their timing of the transactions they do?
Yes, Haydon. So most tax reliefs are per tax year, aren't they? So you only get a certain amount of tax-free gains or investment gains or property gains, however you want to talk about it, in any one year. So you shouldn't sell too much in one year. You know, if you can stagger. So the example you give in the fact sheet is if you've got 2 properties and you want to get rid of them, you know, there will, if they're second homes, and there'll probably be capital gains tax to pay, but you shouldn't sell them both in one tax year, because then you will you'll effectively only get your 12,300 capital gains tax allowance on one of the properties. Whereas if you staggered it by a few months and did them in alternate tax years, then that 12,300 would be applicable twice on each sale.
Yeah, I mean, that's a really good example, but there are heaps of different ways that you can time things in terms of putting money in, taking money out, and you'll be amazed that when you plan for that, how much you can actually save doing that. So thanks for helping clarify that. Have you got anything else you'd like to add, do you think?
I've got a couple of points that we haven't covered elsewhere. So if you're selling a business, then we're an employee-owned company, and it works very well for us. And a lot of people don't really consider that employee ownership is a really good option for passing on a business to the next generation. But there's a lot of information out there from the Employee Ownership Association, for starters, about how you might go about doing that. So that's something to consider. And of course, there's entrepreneurs relief, which is a form of capital gains tax relief that you can apply for as well. Again, that's in our tax tables. I also wanted to touch on the fact that, of course, inheritance tax is a biggie, and most of our clients absolutely accept that paying tax is their civic duty, but it's helpful to know that you can pass as much money as possible to the next generation. So that can be something that's factored in once you know that you're going to have enough money for your lifetime. Then it's kind of the next step to consider what inheritance tax allowances might be applied for, etc. And then the only other point I wanted to touch on is that inflation, of course, will be eroding the future purchasing power of your investments and your pensions. And really, that's why most people bother to take the risk of investing, is so that they can grow their money over and beyond inflation, so that it keeps its real purchasing power many years into the future.
Oh, that's great. That's some really good extra advice there. So yeah, very thorough. Okay, number 7. Let's widen this out a bit. We've largely touched upon what we do for a retired couple or a retired individual. We touched upon others that are impacted, but let's dwell on that a bit more. So not everybody, but a lot of our clients have got children, and they're the obvious next party that you bring into the mix in terms of planning properly. And yeah, often part of your retirement is to take into consideration how you want to help your children or others in future. I mean, you must see that, mustn't you? Don't you, Olivia?
Yes, absolutely. And so you've worked out what you need to live on, and if you're lucky, there'll be some surplus. So then it's okay, well, do you want to give that away now in your lifetime rather than just leaving it in your estate? And then you can see the benefit of the money, you know, the benefit that it has for your family while you're still alive, which is rather lovely. But of course, we need to make sure that you've got enough for potential long-term care, you know, so we do caution people against giving too much away, of course. But one thing, while you're thinking about your own retirement, I've actually set up pensions for my children. So they're 10 and 13. And you don't have to put much away. I mean, you know, 20 quid a month is the minimum. But because it'll be invested for such a long time, I won't be around probably to see them when they're in retirement. But I know that I've put a little bit away now that will be invested for many, many years for their future. And you can do that for grandchildren. So that's maybe for small pots, that's quite a nice thing that you can do while you're thinking about your own retirement, is think about then the future retirement of other generations at the same time.
Yeah, no, it's common. It's a common objective that people come through the door and they say, okay, look, I want to look after myself in retirement, but I also want to help my children, but I'm afraid that I might give away too much or not give away enough. So that's all part of the planning process that we help guide people. It might be that we end up saying, well, look, you can afford to give both your children £50,000 now, and this means you can still survive on X, or it might be more than that, or why don't you stop drip feeding money out, as Olivia said. So yeah, a proper financial plan that's working towards your retirement would often involve this type of additional planning in the whole mix. And
we shouldn't forget philanthropy as well.
Of course.
So you might want to say, well, I'm going to give 5% of my, or 5 to 10%, say, of my income or capital to charitable causes now. So lots of people leave money to charities in their wills, but it's rather nice, again, to do it in your lifetime so that you get the benefit of seeing the good that your money can do in the world.
Yeah, I mean, I've dealt with a number of clients over the years where typically they will inherit some money. So they might be in their 60s and their own parents die and they're coming to a large lump sum. And then they might split that money. So set up a charitable trust fund with them as trustees. That's really tax efficient thing to do. And then they enjoy the fact that it's doing good in the world, but then they still retain some of that remaining money for themselves or give it to the children or something. And again, we would work through with the client on how they can do that and all the different elements involved. Okay, let's move on then. Let's just dwell upon number 8 now. We've touched upon some of these things already, but let's bring this together. Can I afford it? What might change in the future? So we put this really detailed plan together. How realistic are your assumptions? You need to ask yourself that. Have you really got the money to do what you want to do? Or once you actually build that plan, you find, okay, no, I need to make some changes. I can't retire as early as I really want to. I might have to work a bit longer. Or it might be the opposite. You're planning to retire at a certain age, but what you actually find is, I can definitely afford it. I've got more money than I expect. So I'm going to retire a couple of years earlier. So yeah, what might change? You might change your plans that come out of this. I don't know. Have you got stuff to add on this, Olivia? What do you think about affordability?
I think the main thing to bear in mind is that if you develop your savings habits early, then that will dramatically increase the chances of success. So we usually say if you can save 15% of your income throughout your working life, you'll be on track for a really healthy retirement income. Just as a goal, we don't always manage it. I certainly wasn't saving 15% when I started out earning, a pittance. You can't always afford it, but it's a good figure to have in mind as a goal.
Yeah, I mean, it is. That's excellent advice. I know we touched upon this in the past. I think we've sort of toyed with maybe 10%, 15%, something around that sort of number works. I guess the other thing you've got to do is also try and think of the worst case scenario. So you've got your planned lifestyle, you visualized at the start, and you see where you want to get to. But one obvious factor that people are affected by is the potential of paying care fees. And care fees can be expensive.
Yeah.
So if you go and see a financial advisor and that's a concern, do raise it. They'll probably raise it anyway. But it's important to look at the numbers, and you can even go down to the level where you call a care home that you think ultimately you might go to one day if you need to, see what their rates are and take those figures along to your advisor, and they'll be able to map that out within their cash flow planning.
On average, it's about 50 grand a year for full-on care. But by that point, you've probably sold a property, or you probably would be able to sell a property. but depending on, your spouse might still be there, of course, but we tend to do cash flow forecasting to age 100, don't we, Haydon? But as we all live longer, though, we may have to extend our projections.
Yeah, I guess the final thing to touch upon this is it's important to determine how you pay for things. Sometimes I'll suggest to a client that they have a certain investment X. It works well for them, and they ring fence that mentally and think, well, okay, that's the money that I'm going to pass on to my children one day. So you can almost treat that differently to some of the other investments or pensions they've got. So determining what you want to spend money on and how you're going to pay for it in the future can work. And there's also tax efficiencies around how you structure that. But that's too much for today's discussion, but those type of things are important. Shall I move on to number 9, or you anything?
No, yeah,
more?
I was going to talk about trust, but as you say, that's a whole other topic, isn't it? So there's no need to talk about putting money in trust today.
Yeah, no, trust planning is a very powerful thing, but I mean that's a long discussion in its own right. So I think we should park that for now. Okay, so throughout the discussion, we've said, look, do some of this stuff yourself. You go somewhere else to get some help. What are your thoughts, Olivia?
Well, we always say, don't we, that we're there to provide support for people if they don't have the time or the skills or the inclination to do it themselves. So I think if you've got the time and the skills and the inclination, go for it. If your affairs are relatively straightforward, you might well be able to put together a plan that's robust enough to get you from A to B. But we do find that lots of people haven't really approached it and aren't able to in this structured way, and so need our assistance.
Yeah, it can be often the case that where you've got several objectives, you've got fairly complex affairs. If you've got a quite large estate, you may need that professional assistance, and also you can save a lot of money getting it right and mitigate some of the risks. So it's worth considering. And also the other thing with when an advisor talks to you, they won't just give you solution A. I'll often give solution A, B, C, and D, and talk to you about the different outcomes, different scenarios, and then we can have a follow-up detailed conversation about that, and then we can opt for one of those plans, which we know can change over time, and keep the other scenarios in mind. So yeah, some good powerful stuff there. If you do pay for advice, it's usually worth it, but I would say that, wouldn't I? Okay, I think we're coming to the end or thereabouts. So let's just touch upon number 10. What should you do next? You're looking to retire. What do you think? Talk to us.
Read our fact sheet. There's a money advice service, isn't there, online, which is has quite a lot of useful introductory information. I wouldn't say it's very detailed. But I think everyone, even if you think, oh, I wouldn't want to do this on my own, I think just starting thinking about these topics and putting pen to paper to some extent is really empowering, and it's so reassuring to start that process and get some semblance of a plan together. And also it will help your advisor, if you do decide to take financial advice, get the right solution for you, the more sort of legwork you've done in advance.
No, absolutely. I personally love it when a client comes along and they've thought about a lot of this stuff in advance, because it can make the conversation more meaningful. Not to say that the clients that haven't done that, we'll still get there. There's no question about it. But yeah, Money and Pension Service website, that's a good place to go to. It can give you some pension tips. There's some videos, etc., that you can watch so you can get a feel for this type of stuff. Good. I think we're about there. So thank you. Thank you for joining us. You've made it this far. 10 steps to planning your retirement. If you think this is something that we could help you with, do get in touch. We typically look at help clients that have got $500,000 and above to invest. So if that looks like it could be you, then use the details that you see before you and look on our website and get a hold of us, and we'll see what we can do. Thank you for joining me, Olivia. Have you enjoyed it?
Thank you, Haydon. I have. Thank you, Haydon. It's been great. Look forward to the next one.
Excellent. See you again.